Let's look at what the weakness in Netflix shares right now means for the markets. We're joined by Rob Arnott, Chairman and CEO of Research Affiliates. He's joining us from Newport Beach, California, as we see those Netflix shares continue to decline by about 13%. Rob, it's great to see you. Thank you for joining us. So we were just talking about Netflix and its importance to the sort of momentum story. Do you think its troubles here are also going to spell troubles for other momentum stocks?
Of course, there's a distinct risk of ripple effects. I published a piece a few months ago entitled "It's a Bubble, So What?" And in that paper, we talked firstly about the definition of the word bubble. People use the word left and right without bothering to define it. And secondly, we point out some areas in which the market is frothy enough to be characterized as a bubble. And thirdly, we offer some advice on what to do about bubble assets.
All right, so what do you do about them?
Well, let's start with the definition. I mean, people use the word left and right. What is a bubble? We offer a very simple definition, and that is, in any valuation model, anything like a discounted cash flow model or anything like valuation ratios, forward PEs, that kind of thing, you have to use implausible assumptions, not impossible, but implausible assumptions to justify today's price. Second part of the definition is equally important. In order for it to be a bubble, the marginal buyer, the person buying at today's price, has to simply not care about any valuation models or valuation ratios. So, using that definition, is Apple or Microsoft a bubble? No, they're a little expensive, but they're not a bubble.
What about Netflix, Rob? What about Netflix? We're looking at that, yeah.
Yeah, Netflix and Tesla. My goodness, does any marginal buyer of Netflix or Tesla look at valuation ratios, or do they look at the story? I think in both cases they qualify as a bubble. Being a bubble doesn't guarantee that they'll underperform long term, but it makes it awfully likely.
And Rob, so how worried should people be about those specific bubbles, Tesla and Netflix, popping anytime soon?
Oh, I think people should always be worried. Bubbles can pop at any time. The other aspect of a bubble is equally important, and that is that bubbles can persist longer than you can remain solvent. In that paper, I used the example of Zimbabwe stocks during their currency meltdown. Late stages of the currency meltdown, but not at the end. The currency fell tenfold in the space of 8 weeks. During that 8 weeks, their stock market rose 500-fold, which means 50-fold in US dollar terms.
Yeah.
You could have been short Zimbabwe stocks and you would have lost 50 times your money. Ouch! Now, the simple fact is, 6 weeks later, their stock market was worthless and stopped trading.
Okay.
So you would have been dead right that it's a bubble and that you need to get out of the way, but dead wrong to short sell.
All right.
Same thing would apply.
So, Rob,
yeah.
I want to just break in here because I want to get to the whole concept of indexes and how, Netflix accounts for a much bigger proportion of the NASDAQ today than it did, say, 2 years ago or even a year ago, since its share price has doubled. I mean, do you think that stock investors who are investing through indexes are aware of their exposure to Netflix, or do you think they're going to be somewhat surprised if there is some kind of popping of what you call a bubble?
Yes. Short answer is most investors in capitalization-weighted indexes aren't aware of the extent to which frothy stocks that may be in a bubble, can dominate their portfolio. We did another paper entitled Buy High and Sell Low with Index Funds, in which we pointed out that index funds, the stocks added to an index, reliably tend to be very pricey stocks that are very popular, so that the index committee says, we got to add this stock. And stocks that are dropped tend to be wildly out of favor, unloved, deeply depressed stocks that are trading very, very cheap. What happens after a stock is added? What happens after a stock is dropped? In that paper, we show that the stocks that are added in the year after they're added underperform the market by 2 percentage points. The stocks that are dropped beat the market by 21 percentage points. wow, that's a huge difference.
Yeah.
So when it comes to indexing, stocks that are at the top of the list usually are very pricey.
Rob Arnott, unfortunately, we have to leave it there. Thank you so much for joining us. Rob Arnott, Chairman and Chief Executive of Research Affiliates. Thank you so much for being with us.